Welcome to GexPro Daily Market View, Thursday edition. The market enters the week with declining labor market momentum, rising long-duration yields, and continued strength across risk assets. Liquidity dynamics remain supportive in the near term, but longer-dated bonds are flashing early stress signals that could constrain future policy cuts. Precious metals, especially silver, continue to show supply-driven breakouts, while digital assets reveal mixed technical structure. Equity breadth broadens beyond megacaps, yet volatility catalysts remain centered on the imminent policy decision and the behavior of long-end rates. Macro conditions continue to shift as labor market data softens further. The most recent job quits figure falls to levels not seen in more than a decade outside of the pandemic period, reinforcing the view that labor demand is weakening. Historically, quits at this level coincide with policy rates materially below their current setting, prompting broad expectations for a rate cut. The immediate question is not whether a cut occurs, but whether it can be followed by a sustained cutting cycle. Long-duration yields complicate that outlook, with market-driven rates rising toward potential breakout levels that challenge the central bank's preferred path. Liquidity remains constructive for risk assets. Equity indices sit near record highs, and options positioning show substantial call interest into year-end around key round number levels. Market breadth improves as smaller companies extend their multi-month advance, reflecting a rotation into higher beta exposures. Risk appetite strengthens despite pockets of macro uncertainty, with many sectors, outside of a few defensive areas, participating in the broad uptrend. Recent flows show renewed participation from both institutional and systematic strategies, with volatility remaining suppressed after an early week spike. Sector performance highlights contrasting narratives. The leading semiconductor group continues to push into new relative highs against the broader equity benchmark, reinforcing the market's preference for growth-linked themes tied to data center expansion and accelerated computing demand. A major chip producer receives approval to resume overseas shipments of an advanced processor, though the receiving market imposes partial restrictions in response. Despite geopolitical sensitivities, the broader takeaway is that global compute capacity remains firmly in expansion mode, and that the ecosystem effects of platform standardization continue to support leading hardware suppliers. Commodities offer a different tone. Silver extends its sharp upward squeeze, driven by long-term supply constraints and rising industrial demand. Mine development timelines remain structurally long, and the metal benefits from renewed speculative flows after breaching multi-year resistance levels. Gold holds firm but trails silver's momentum, with the yellow metal awaiting confirmation through higher break zones. Energy markets consolidate, yet upstream services maintain constructive structure as they historically respond to rising yields and capital expenditure cycles. Industrial metals show pockets of strength as well, aided by the broad global manufacturing recovery. Credit and yield dynamics are central to near-term risk assessment. Long-duration government yields break their recent range and approach levels that imply market disagreement with the central bank's easing roadmap. The 20-year and 30-year tenors show the clearest upward pressure, suggesting that supply conditions and term premium effects are reasserting themselves. Shorter-dated maturities remain capped for now, creating a divergence that could challenge rate cut expectations if sustained. Should long yields continue higher, rate-sensitive sectors such as energy infrastructure may benefit, while duration-heavy assets may encounter resistance. Digital assets generate mixed signals. The primary asset trades in a broad consolidation with well-defined lower support, with a recent liquidation event cleared leveraged positioning. A break beneath that floor would indicate a bearish continuation toward prior cycle levels. But current structure remains neutral, while higher beta tokens show selective strength. A major smart contract asset breaks upward from its consolidation, offering a constructive contrast to the more hesitant behavior of its peers. Flows into spot exchange-listed products remain positive, reflecting persistent institutional interest. Equities overall maintain a bullish bias heading into the policy announcement. Historical seasonality supports further gains into year-end, and options positioning reinforces the probability of a grind higher, provided key supports hold. The crucial downside area lies just below recent consolidation, where volume-weighted levels, option put concentrations, and technical retracement zones align. As long as that band remains intact, the prevailing trend structure continues to favor buyers, even if short-term pullbacks emerge. 3 insights stand out. First, long-duration yields, not the policy rate, are setting the tone for macro risk and may dictate how far easing can proceed. Second, breadth expansion into smaller companies confirms that risk appetite is not confined to mega-cap leaders. Third, silver's breakout underscores the importance of structural supply constraints in commodity markets, offering a counterweight to the more liquidity-driven moves in equities. Overall, market conditions remain constructive, but the next phase will be shaped by how the bond market digests the coming policy shift and whether rising yields introduce friction into the broader risk